Welcome back to the channel. In today's video we are going to dive into the essential components of equity composition, a critical concept for understanding a company's financial structure. We will be covering key elements such as retained earnings, additional paid-in capital (APiC), common stock, preferred stock and treasury stock. Each of these components plays a unique role in shaping the financial health and growth potential of a company. By the end of this video, you will have a clear understanding of how companies manage their equity, how different types of stock work, and why these concepts matter for investors and business owners alike. So, let's get started. This is what we are going to see today. First, introduction to equity composition. Common stock, preferred stock, retained earnings, APiC, additional paid-in capital, and last, treasury stock. All of this after our intro. In this video, we will explore the concept of equity composition and its importance in understanding a company's financial structure. At the heart of every business is the relationship between its assets, liabilities, and equity. The fundamental accounting equation is assets equal liabilities plus equity. This equation, which is the foundation of double entry accounting, helps us understand how a company finances its operations. So let's break it down. Assets. What the company owns. Assets represents everything a company owns. They are classified into two main categories. Current assets. These are assets that are expected to be used or converted into cash within 1 year, such as cash, inventory, and accounts receivable. Non-current assets. These are long-term assets such as property, equipment, buildings, and intangible assets like patents or trademarks. Assets are the resources a company uses to generate revenue and grow its business. In financial statements, assets are typically listed in order of liquidity, meaning how easily they can be converted into cash. And then we have liabilities. What the company owes. Liabilities are the obligation or debts that the company owes to others. They are also divided into two categories. Current liabilities. Those are debts that are due within 1 year, such as account payable, short-term loans, and tax liabilities. And non-current liabilities. Those are long-term debts, such as long-term loans, bond payable, and other obligations that will be settled in more than 1 year. Liabilities represent a claim on the company's assets. If a company's liabilities exceed its assets, it may face financial difficulties, while a well-managed balance of liabilities ensures that the company can meet its obligation without jeopardizing its operations. And then we have equity, what the company owners own. Equity or shareholders' equity represents the value of the company that belongs to its owners or shareholders. It's calculated by subtracting liabilities from assets, so equity equal asset less liabilities. Equity can be broken down into 5 main components, including common stock. This is the amount of company stock that have been sold to investors and not repurchased by the company. Preferred stock, a type of equity that gives shareholders priority over common stockholders in terms of dividends and asset distribution in case of liquidation. Again, retained earnings. Profits that the company has earned and kept rather than distributed to shareholders as dividends. And then we have APiC. It represents the excess amount paid by shareholders over the nominal value of the stock and is recorded in the equity section of the balance sheet. Again, we have treasury stocks. Is the number of shares that have been repurchased from investors by the company. Equity is a crucial indicator of a company's net worth and represents the residual interest after all liabilities have been paid. The relationship, how they balance. The accounting equation shows the relationship between assets, liabilities, and equity. If a company increases its assets, it may also increase its liabilities by borrowing money, for example, or it may increase its equity by raising capital from shareholders or retaining earnings. If a company incurs losses, assets may decrease, leading to a reduction in equity. However, the equation will always balance, meaning the increase or decrease in assets must be offset by a corresponding change in liabilities or equity. The equation also helps ensure that every financial transaction is recorded accurately, maintaining balance in the company's books. Understanding this fundamental accounting equation is essential for assessing a company's financial health. It highlights how a company's resources, assets, are funded either by borrowing, liabilities, or by the owner's investments, equity. This knowledge is critical for investors, business owners, and financial analysts, as it allows them to evaluate the company's ability to meet its obligations and grow sustainably. So let's start with common stock. Common stock refers to the equity capital that a company raises by issuing shares to the public or private investors. Common stock represents ownership in the company and gives shareholders the right to vote on corporate matters, such as electing the board of directors, approving major decisions. In return, common shareholders are entitled to receive dividends, if declared, and share in the company's profit and growth. How is common stock issued? When a company decides to raise capital, it can issue common stock. This involves selling a certain number of shares at a specific par value. The par value is the nominal value of the shares, often a small amount, for example $1 per share. On the contrary, the market value is the price at which shares are bought and sold in open market, which is determined by supply and demand. Common stock is often issued in the form of initial public offerings, IPO, or secondary offering when the company wants to raise additional funds. So now, the rights of common shareholders. Common shareholders typically have the following rights. The first is voting rights. Common shareholders have the right to vote on matters affecting the company, including the election of directors and the approval of major business decisions. Second, dividends. While common shareholders are not guaranteed dividends, they are entitled to receive dividends when declared by the company's board of directors. Dividends are typically paid from the company's profit. Third, capital appreciation. Common shareholders may benefit from an increase in the market value of their shares, allowing them to sell their shares for a profit. And last, a residual claim on assets. In the event of liquidation, common shareholders have a residual claim on the company's assets, meaning they will be paid after all creditors and preferred shareholders have been compensated. However, this is often a riskier position compared to preferred shareholders. Common stock and equity. In the company's balance sheet, common stock is part of shareholders' equity. It represents the initial investment made by shareholders when they purchase shares. The value of common stock is recorded at the par value of the shares, while any amount received over the par value, if shares are sold above par, is recorded in the additional paid-in capital, APiC. For example, par value share, $1. The shares issued are 10,000 shares. The common stock recorded on the balance sheet are $10,000. Common stock and financial health. The value of common stocks and its market performance provide an indicator of the company's financial health. A rise in the market price of the company's common stock often signifies investor confidence in the company's future growth. Conversely, a decline in share price may indicate potential issues or a loss of investors' confidence. Preferred stock. Preferred stock is a type of equity that combines features of both common stock and bonds. Preferred stockholders have special rights compared to common shareholders, particularly in terms of dividend payments and priority in case of liquidation. So what is a preferred stock? Preferred stock represents a class of shares that grant holders privileges over common stockholders. While preferred stockholders typically don't have voting rights unless a specific condition are met, they enjoy significant advantages. Preferential dividends. Preferred stockholders receive dividends before common stockholders. Moreover, dividends on preferred stock are usually fixed and not variable, unlike common stock dividends, which can fluctuate. Again, priority in case of liquidation. In the event of bankruptcy or liquidation, preferred stockholders are priority over common stockholders in the distribution of remaining assets. There are different types of preferred stock, each with specific characteristics. The main types include cumulative preferred stock. If a company is unable to pay dividends on cumulative preferred stock in each period, those dividends accumulate and must be paid before any dividends are given to common stockholders. Then we have non-cumulative preferred stock. If a company misses a dividend payment on non-cumulative preferred stock, dividend doesn't accumulate. This means that the preferred stockholders will not be entitled to receive the missed dividends in the future. Convertible preferred stock. This type of preferred stock allows the holder to convert the preferred share into a specified number of common shares, usually at a predetermined price. This provides an opportunity for capital appreciation if the company's stock price rises. And then we have participated preferred stock. Holders of participating preferred stock receive their fixed dividend and, in addition, participate in the distribution of any remaining profits along with common shareholders up to a certain limit. So now, why is preferred stock important? Preferred stock is an attractive option for both companies and investors for the following reasons. First, capital without dilution. Preferred stock allows companies to raise capital without diluting control over the company, as preferred stockholders typically do not have voting rights. Stable income for investors. Preferred stock is particularly attractive to investors seeking steady income because of its guaranteed dividends, which are often higher than those paid to common shareholders. Again, financial flexibility. Since preferred stock dividends are not as fixed as debt payments, it provides greater financial flexibility for the company, especially during periods of financial difficulty. And again, lower risk compared to common stock. Preferred stockholders have a lower risk compared to common stockholders due to their priority claim on dividend and liquidation proceeds. In financial statements, preferred stock is listed in the equity section of the balance sheet, typically below common stock. It's recorded as par value, with any additional funds raised above their par value classified as additional paid-in capital. Then we have retained earnings. Retained earnings are one of the most important components of a company's equity. It represents the cumulative amount of net income that a company has earned and retained over time, rather than being distributed or as dividends to shareholders. Essentially, retained earnings reflect the profits the company has reinvested back in the business to fuel growth, pay down debt, or for other corporate purposes. So what are retained earnings? At its core, retained earnings are calculated as net income less dividend paid. So, net income, this is the company's profit after all expenses, taxes and interest have been deducted from its revenue. Dividend paid, these are the earnings that the company distributes to its shareholders as a return on their investment. Any portion of net income not paid out as dividends is considered retained and remains on the balance sheet under equity. Why are retained earnings important? Retained earnings play a crucial role in the company's long-term growth strategy. Here's why they matter: source of capital for expansion. Retained earnings allow companies to fund expansion without having to rely on external financing, like issuing more shares or taking on debt. It can be used to purchase new assets, build new facilities, or invest in research and development. Again, debt repayment. Companies with substantial retained earnings may use them to pay down existing debt, which can improve their creditworthiness and reduce investment payments in the future. And reinvestment for future growth. Retained earnings enable companies to reinvest in their core business, whereby improving operations, upgrading technology, or exploring new markets. Again, dividend decisions. Retained earnings can be used to adjust dividend policies. If a company wants to maintain or increase dividend payouts without issuing new debt, it can use its retained earnings to fund those distributions. And tax consideration. Retained earnings are not subject to double taxation like dividends, which are taxed on the corporate level and again when received by shareholders. How are retained earnings reported? In financial statements, retained earnings are reported on the equity section of the balance sheet, often under the heading Retained Earnings or Accumulated Earnings. They are updated at the end of each accounting period based on the company's net income and the dividend paid out. The retained earnings statements, or statements of retained earnings, provide a detailed overview of changes over a specific period. The statement often looks like this. Beginning retained earnings, $500,000, for example, net income of the year, $150,000, dividend paid, $50,000, so ending retained earnings, $600,000. So which are the key factors that may affect the retained earnings? First, profitability. The more profitable a company is, the larger its retained earnings will be. Assume it doesn't distribute too much of its profit as dividends. Dividend policy. If a company decides to pay out a significant portion of its profit as dividends, the amount of retained earnings will be reduced. And then accounting adjustment. Sometimes accounting adjustments or correction to previous period's earnings can affect retained earnings. So now let's talk about retained earnings and company performance. Investors often look at retained earnings as a measure of a company's ability to grow without relying on external financing. Consistently growing retained earnings are often a sign that the company is managing its profit well, reinvesting wisely, and maintaining a healthy balance between reinvestment and shareholders' returns. However, it's also important to note that too much retained earnings may indicate that the company is not effectively distributing its profit to shareholders, especially if it has limited reinvestment opportunities. In such cases, shareholders may demand higher dividends or the company may need to reconsider its allocation of profits. So to summarize, retained earnings are vital to the overall financial health of a company. They provide the internal funds necessary for expansion, reinvestment, and debt reduction, all of which contribute to long-term sustainability and growth. By properly managing retained earnings, a company can avoid external financing costs and maintain control over its business decisions, ensuring that the company remains competitive and profitable over time. Okay, now it's time to talk about the APiC, additional paid-in capital. Also known as capital surplus, refers to the amount of money a company receives from issuing shares above their par value or nominal value. When a company issues shares, they typically do so at a price higher than the nominal value of the shares. The difference between the issue price and the nominal value is recorded as APiC. How is APiC created? When a company issues shares at a price higher than their par value, the excess amount is considered paid-in capital, so par value. The definition: this is the face value of share, typically a small amount, $1 for example, per share. The issue price is the price at which the shares are sold to investors, which is often higher than the nominal value. For example, $5 per share. For example, the par value of share is $1, the issue price of share is $5, so the APiC per share is 5 less 1, $4. So if a company issues 1,000 shares as $5 each, the total APiC would be 1,000 shares times 4, APiC per value, $4,000. Why is APiC important? APiC plays a significant role in a company's equity structure. First, strengthening the balance sheet. APiC strengthens the company's equity by adding to the capital base without changing the nominal value of the shares. It increases the overall value of the company's equity, making it more resilient in case of financial difficulties. Second, funds for growth. Like share capital, APiC represents funds raised by the companies from investors. However, it can be used to fund expansion, research and development, and other growth initiatives, without diluting the value of existing shareholders' holdings. APiC is usually not distributed as dividend. Non-dilutive capital. Because APiC doesn't affect the nominal value of shares, it's considered non-dilutive capital. It helps the company raise additional funds while maintaining the same shareholding structure. And again, tax treatment. APiC is not subject to double taxation, unlike dividends, which are taxed at both the corporate level and the shareholder level. This makes it an attractive option for companies looking to raise capital without incurring extra tax burdens. And last, accounting. Under United States General Settled Accounting Principle, APiC is reported separately from share capital, also called common stock or preferred stock, reflecting the difference between the par value and the amount paid by investors. This transparency helps investors and analysts understand the true capital raised by the company. APiC in financial statements. APiC is listed under shareholders' equity on the balance sheet, along with the par value of common stock and retained earnings. APiC and shareholders' value. APiC is essential for companies looking to raise funds without diluting their shareholders' base or taking on debt. By issuing shares at a premium, companies can maintain a strong equity position and avoid excessive leverage, while also attracting investors who are willing to pay more than the nominal value for a stake in the business. The last chapter is about Treasury Stock. Treasury Stock represents shares that were once outstanding, issued and held by shareholders, but have been repurchased by the company. The shares are kept in the company's treasury and are not counted in the total number of shares that are used to calculate earnings per share, dividends, or voting rights. Treasury stock is usually purchased by the company for one of the following reasons. First, to boost stock price. By reducing the number of shares outstanding, treasury stock can create scarcity, which can increase the price of remaining shares. Second, to return capital to shareholders. A company may repurchase shares as a way to return cash to shareholders, especially when it has excess cash on hand and doesn't want to pay dividends. Then third, to increase earnings per share, EPS. By reducing the number of outstanding shares, the company's earnings per share can improve, which can make the company appear more profitable to investors. And 4. To have shares available for employee stock option or acquisitions. So how is treasury stock treated? First, non-dilutive. Treasury stock doesn't count toward dividends or voting rights, as it is considered inactive. This means that the total number of shares in circulation is reduced by the amount of treasury stock. Then, second, no effect on common stock. The par value of treasury stock is not considered when determining the company's common stock or shareholders' equity. However, the purchase price of treasury stock is recorded in the company's balance sheet as a deduction from equity. Repurchase price. When the company repurchases its own shares, the cost of the repurchased share is recorded in the treasury stock account. If the company later resells the shares, any difference between the purchase price and the selling price is recorded in the equity section. Treasury stock in the balance sheet. In the equity section of the balance sheet, treasury stock is recorded as negative entry, reducing the overall equity. For example, if a company buys back 1,000 shares at $10 each, the treasury stock is recorded as $10,000, decreasing the total equity. The company can choose to reissue their treasury shares or cancel them, which would permanently reduce the number of shares outstanding. When a company buys back its own shares, the total number of outstanding shares is reduced, which can result in an increase in earnings per share. Since earnings per share is calculated by dividing net income by the number of outstanding shares, buying back shares lowers the denominator and can artificially boost the earnings per share, which might be seen as a sign of financial strength. So we reach the conclusions of this video. To sum up, understanding equity composition is crucial for anyone involved in business or investing. We are exploring the key components that make up a company's equity, including retained earnings, which reflect the company's ability to reinvest profits back into the business, the additional paid-in capital, which strengthens the company's equity when shares are issued above their par value, common stock, which represents ownership in the company and comes with voting rights and dividends, preferred stock, which offers preferential treatment in dividends and liquidation, but generally lacks voting rights, and last, treasury stock, which includes shares repurchased by the company and reduces equity. Each of those elements contributes to the company's financial health, affecting its ability to grow, raise capital, and provide value for shareholders. Understanding how they work together gives us a deeper insight into a company's financial strategy and long-term sustainability. So, if you found this video helpful, don't forget to like, subscribe, and leave your comments below. We will be back with more insights into business finance soon. See you next week!